Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, March 21st, 2022. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you on. So let's see here. Let's start it off. As you know, the Japanese Ministry of Finance recently released the January balance of payment data. Similarly, the U.S. Treasury recently released the January tick data. I'm curious what these reports showed, specifically as it pertains to appetite for U.S. Treasuries. And let's broaden this out, among not only Japanese investors, but Asian investors more generally.
According to the U.S. tick data released on March 15th, Japanese investors net bought $2.2 billion of U.S. Treasuries, $1.7 billion of U.S. corporate bonds, and $900 million of U.S. government agency bonds. U.S. tick data shows that Chinese investors were also buyers of U.S. fixed income, buying a net $19 billion of U.S. Treasuries, $10 billion of U.S. government agency bonds, and $134 million of U.S. corporate bonds. According to Japan's balance of payments BOP, Chinese investors continue to net buy short-term yen bonds by 1.5 trillion yen and medium to long-term yen bonds by 407 billion yen in January. Both data show that Chinese investors bought U.S. Treasuries, U.S. government agency bonds, TDBs, and JGBs. This suggests that Chinese investors, like Japanese, have acted as a cushion for the U.S. bond market.
Yeah, that's interesting. So both Japanese and Chinese investors, buying both treasuries, and then Chinese investors also perhaps doing some cross-currency arbitrage, taking dollar funds and putting it in the JGB market. Right. You also made the point in one of your cross-asset pieces that Japanese investors increased their exposure to U.S. corporate bonds starting in December, but then continuing in January as a cushion to rate hikes, as speculation of a faster pace of Fed hikes mounted. That was pretty interesting reaction as well. And I definitely encourage our listeners to check out your research piece for more there. We could probably spend an entire podcast on balance of payment and tick data, as you know. But in an effort to move on, last week was a big week for monetary policy, really across the globe. You had a meeting here in the States, with the Fed, the Bank of England met, the Bank of Japan met. Take our listeners through the high points from the Bank of Japan's March policy meeting and also the implications.
The Bank of Japan, the BoJ, made no change to monetary policy at its March 17th to 18th Monetary Policy Board meeting. The BoJ did revise down its assessment of Japan's economy from the October outlook report in January to stress downside from the Ukraine crisis, and also stress inflation upside further. Looking ahead, we think the BoJ's monetary policy stance will be relatively loose compared to other G10 central banks. This will support yen weakening and yen basis widening. Last week's BoJ decision impressed us in terms of the autonomy of monetary policy stance relative to other more hawkish central banks. We expect the policy decision to support a neutral bias for yen rates, even if rates around the world rise.
Yeah, well said. I mean, I think it was actually Derek, maybe in his podcast this week, but he talked about you really had a great spectrum of central bank reactions. The Fed was very hawkish, the Bank of England more dovish, and the BoJ, as you point out, even more dovish. So let's expand on this a little bit. You took us through what happened at the March policy meeting. More broadly, what are your expectations for Bank of Japan monetary policy going forward?
In March, the BoJ repeated its assessment of inflation and appears to have left room for making an adjustment to policy operations in the second half of the year. We think that after the July upper house elections, the BoJ could begin to fine-tune its tools of supplying funds to the market while not changing the framework of YCC operations. Assuming first, inflation upside picks up, and second, the COVID pandemic is contained, and third, conditions for introducing new means of supplying funds arise. Specifically, we think first, the BoJ will not change its range for YCC operations before April 2023, when Governor Haruhiko Kuroda's term ends. And second, it will bolster its climate change countermeasure operation and lending support program in order to maintain its overshooting style of commitment once the COVID countermeasure operations end in September. As long as the BoJ maintains its overshooting style of commitment, it will have to leverage maintaining the monetary base over the medium to long term, even if it allows the monetary base to decline over the short term. Over the near term, the BoJ will need tools to increase policy effects, especially with climate change operations and the lending support program, without allowing the monetary base to decrease while using current deposit interest rate incentives. Otherwise, Japan's monetary base will certainly shrink. Also, the outcome of the upper house elections, July upper house election, the political power map will determine whether the BoJ walks towards normalization in anticipation of the post-COVID economy, or whether it maintains the monetary easing. Any changes in Prime Minister Fumio Kishida's popularity or Japan's political dynamics along the time of the July upper house elections will likely affect the BoJ's policy decisions.
Okay, so it sounds like the BoJ is likely to stay on course, but with some subtle but important, important changes needed, and obviously all subject to, the political winds in Tokyo. I think at this point we're about out of time, but wouldn't want to wrap things up without getting your outlook across yen rate, spot dollar yen, and yen basis markets. So take us through it.
Okay. Yen and Swiss franc are soared because of the pause in risk aversion stemming from the war in Ukraine and the pause in rising oil prices. Resource-producing currencies, Aussie dollar and the Canadian dollar, have also weakened. Euro and other European currencies are being bought back. Yen has weakened more than dollar, and dollar yen has touched the 119.12 mark for the first time since February 2016. Over the near term, dollar yen could test the 120 level if an end to the Ukraine crisis appears in sight. But the pace of rise for dollar yen has been too fast and is likely to slow. Oil prices falling will lessen yen selling pressures. We expect the dollar yen trading range 3 yen, 117 to 120, with a bullish bias turning to neutral. The yen swap rate curve has risen and steepened, while the Ukraine crisis remains stuck. Market sentiment has improved, and Japan stocks and Japan yen rates have risen in response. Japan's government plans to lift the quasi-emergency measures to contain the spread of the COVID. We expect the yen rates to shift from crisis mode to neutral as end March approaches. Yen rates will likely return to a neutral bias from downward bias. The front end through the belly of the yen basis curve has tightened. Minister of Finance weekly securities flow data shows that the Japanese unloaded a net 177 billion yen of overseas securities, and overseas investors unloaded a net 575 billion yen of Japanese securities between March 5th to 6th to 12th, as both sides were net sellers. Japanese net sold large amount of overseas stocks and investment fund holdings by 194 billion yen as well as medium to long-term falling bonds by 164 billion yen. In contrast, they net bought 181 billion yen of falling short-term bonds. Japanese investors shortened the durations of their falling bond positions ahead of the Fed rate hike. Overseas investors net sold 1 trillion yen of Japanese stocks and investment fund holdings and a net 864 billion yen of short-term Japanese bond. Against that, they net bought 1.3 trillion yen of Japanese medium to long-term yen bonds. Overseas investors net bought around 1.3 trillion yen of medium to long-term yen bonds for 2 straight weeks, a reflection of their strong preference for JGB asset swaps. But they sold off more Japan stocks, helping to drive the Nikkei average lower. Over the near term, pricing could clearly reflect the structure of the Tokyo market. Arbitrage trading flows by foreigners could drive the yen basis pricing. Japanese investors still have unimplemented overseas investing projects in the pipeline, and their moves should be watched through the end of the fiscal year. We revise our view for the yen basis bias from neutral to tightening.
That's a great summary of recent high-frequency cross-border flow data, showing selling on both sides, but also, risk reduction among stocks with overseas investors in Japan and a preference for JGB asset swap. But interesting that you're largely neutral across markets, and we're obviously heading into a key time in Japan, as we're about to wrap up the 2021 fiscal year end. And always great stuff, Sekido-san. Thank you very much for joining us.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.